The biggest and probably the hardest financial goal for most people is figuring out how much to save for retirement. It's like we don't want to save too much. That sounds like a good problem, but we really don't want to save too much, so much so that we don't enjoy our life on the way to retirement. But then we certainly don't want to save so little that we run out of money in retirement. And now so many people are struggling without having anywhere near enough money to retire. So in this video, I want to show you a great way to figure out how much you need to retire. I recently did a video showing you my formula for how much you need to retire. I'm going to take it a step further in this video and show you a calculator that I really like that will allow you to enter your own data. You can play with this calculator, you can tweak your numbers, you can influence your own financial destiny so that you do have enough to retire, and you can see how much you need and what you need to do and or change differently, whether that's related to your earning power or your investing return or whatever it is that you're doing to save money so that you have enough to retire. I'll see you at my computer. Okay, so here we are at the calculator that I was telling you about right here. And the calculator, you can find it yourself at honestmath.com. You don't have to link your accounts or do anything like that. All you have to do is give them your email address, and then you'll need to go to your email and confirm that it's a good email address. And then you'll have an account at honestmath.com, and you will be able to run your own numbers and play with the calculator. Okay. So let me say that I am not in any way affiliated with this. It's just something that I want to show you here because I like sharing financial information. This channel is all about helping people save enough to retire and, you know, what to do if you need more money in retirement and that sort of thing, based on my own experience of stumbling into early retirement with my husband and my own experience investing over the past 40 years, plus 40 years now. Okay, so here we go. Now, I entered for the first name 56-year-old because in this example, let's use a 56-year-old. I know a lot of you viewing my channel are sort of, you know, mid 40s to mid 60s. So let's go with a 56-year-old. Let's go with a birth date of March 1967. And let's go with someone that's not retired yet. And then let's say that this person wants to retire when they're 60 years old. And I'm relatively new to this calculator myself, so bear with me. I played with it just a little bit before I started this video, but I wanted to go ahead and get this done so I could share it with you. Okay, and then life expectancy. Now, the default when you come in to do this is going to be 80 years old. I personally feel like that is not old enough. Maybe it's because wishful thinking. I'm planning on wanting to live longer. Maybe it's because I'm older and I feel like that doesn't seem that far away. I think when you're younger, you know, you think 80 seems so far away. But it also, based on life expectancy, a lot of people live into their 90s. And we don't want to plan for living only to 80 and run out of money when we're 83 or 84, just when we're really, really wanting to slow down, right? So I personally like using 90, maybe even 92. So that's what I put in. You can put in anything you want. All right. And that's what this video is about. It's really encouraging you to do this yourself and empowering you, embracing your own numbers and your own financial journey. Okay, so life expectancy of 90, and then we're going to come down and we're going to enter this area. Will have the amount of income that you have right now. So I put in 60,000. That's around the average income in the United States for one person, and that is at a growth rate of 2% a year. So that salary is growing about 2% a year. And then I put in here expected Social Security of around 3,800, and I put that's for two people. I'm going to assume this is a married person, perhaps because I'm married myself, but say for two people, about 3,800. That's close to the average for Social Security. And then I put in here to start taking Social Security. As you know, if you watch my channel, you can start as early as 62. I put starting at age 66. That's closer to that full retirement age that influences so many factors in the amount you're going to get. So I put 66 and then to age 90 because that's the number we're living until. And then I said a 2% growth with Social Security. I don't know, what that'll be, right? And we also, of course, also don't know 100% Social Security is going to be there and it won't decrease, right? So that's why I love to have, well, we'll talk about in a second, the other income streams as possibilities and or saving as much as we can. Okay, so the next section is pension. I'm going to put 0 for pension because most people don't have pensions anymore. I know quite a few of my viewers have noted that they do have pensions, but I'm going to put 0 in here since most people no longer have pensions. And for other income, if you watch my channel, you know I love alternative income streams. I like to remind everyone there's so many ways you can generate alternative income streams. That's sort of the avenue that we took when we stumbled into early retirement. And there's so many different things you can do, everything from investing and things like real estate and various types of partnerships and investments that have a higher yield and or publicly traded investments that have a higher yield than a typical, IEF, like ETF, kind of bond ETF. There's just a lot of things. And then, of course, you can generate income streams from something like consulting or from something like online services, outsourcing online. So a million things you can do here. We're very, very, very fortunate in that way because my great uncle Blake that I talk about here, he didn't have that option, right? You save the money, and if you didn't have enough, then that was it. Now we've got the internet, we've got lots of options, we're living longer, we're doing more, we're able to do more. So anyway, that's my spill on that. But I'm going to leave it at 0 just to keep it simple, and because a lot of people don't have alternative income streams. So you can come in and play with this number. This is one of the best ways you can increase your situation and or decrease the amount that you need to save for retirement. Okay, then you scroll up and you go to portfolio, and we're going to make an assumption that this person has saved $500,000. So we've got 500,000 there. And then this was the portfolio started at age 56, their portfolio blend, and this picked it up from the prior page, I believe, because 56 was already in there. And then we're only going to 90. It says 99, but I don't think it matters because we're only going to 90. And then the default blend was 60% in stocks and 40% in bonds. I'll say quickly, please do not think in any way I'm recommending this, I'm suggesting this. It's a very common asset allocation for people that are older. And I also will just throw out really quickly, this is not how I invest. You may have seen in my other videos, I am not a buy and hold investor. Instead, I tend to be a more tactical investor. I feel like we already are buy and hold investors just with our home and the real estate we own. So that's a large part of our net worth that's already buy and hold. So with our liquid assets, I like to be more tactical in nature. So I invest in an ETF rotation strategy. I've done another complete video, 2 or 3 videos on how I invest. I'll put a link to that video in the video section below this. If you click on more, you can see that. And I also have a course on my website, retirecertain.com, where I teach all about investing, and that's based on my 40 years of investing myself. So I'm going to leave this at 60-40, and just want to make it really clear that's not what I'm doing. Okay, and this is not at all advice. This is showing you how to use this calculator. That my advice would be go use this calculator, play with your own numbers, and that's as far as my advice would go. Okay, now let's go down here and let's add some regular contributions. So this will be once a month. This person is very disciplined, and they're going to save $1,000 a month, and they're going to increase that amount by 3% a year. That's the average for inflation, the very long-term historical average. So let's say they're going to keep those contributions up with inflation, 3%, and that's going to happen immediately. But at retirement, they're going to stop making those contributions because, let's face it, well, they won't have that income anymore unless they have other income streams, which we saw we didn't put any other income streams in here. All right, and then I'm just going to leave this section here. Now let's scroll up and let's pop over to expenses, and we can see the spending section. I understand that you all are all over the place. I hear in your comments, some of you love living extremely frugal. Others of you at least, 10, 15,000 a month, So why don't we say for someone that's making 60,000 a year, and they're also going to have, remember, they're going to have Social Security. And I am going to make an assumption. I don't really like making assumptions, but in this case, I'm going to make an assumption that they're factoring that in. So in this case, let's say they spend $5,000 a month, okay? And they're going to increase that amount annually at 2% so they can maintain their standard of living. That's something we all will have to do in retirement so that we can just buy what we bought the year before. 2% seems a little bit low to me. To be safe, I like to be really conservative. So I might say 3% here, and that's based on just a lot of factors. That's probably playing it really safe. Could be wrong, who knows, but I'm going to say 3%. And then the other thing you can put in here are taxes. A lot of variables here depending on the structure of your retirement account. This says taxable portion of your portfolio, the estimated percentage of your portfolio subject to taxes upon withdrawal. 75% is the default. I'm going to just leave this taxable portion of retirement income. Again, a lot of variables, estimated percent of Social Security, pension, and other income subject to taxes. So let's say 80%. That's pretty high for this person based on their earnings, but better safe than sorry, and who knows, taxes might go up. Effective tax rate is 20%. I feel like that's a little bit high based on the numbers we're seeing, but that is the default. I'm tempted to just make this, well, hey, a lot of people have state taxes as well. So let's leave that at 20%, and better safe than sorry. And then we're not going to add any irregular withdrawals. We're just going to make that assumption that there are going to be those regular, typical retirement account withdrawals. And let's pop into settings. There are a couple of things here that can be adjusted. We'll see that the amount that is expected return for stock, so that's based on the calculation, is 8%, 4.5% for bonds. Here's the standard deviation for that and the correlation coefficient. You can change these if you'd like. They have said we advise caution when deviating from the default assumption, so we're certainly going to go with that. And we do want to include fat tails, and that simply means that because there's a lot of volatility in stock portfolios, this will help consider or account for that volatility in the calculation. And so we're going to leave that checked and just go with the default here. And do we want to say that we think there's going to be a black swan, which is a completely unexpected event? There are black swans, and they're just a fact of life. Over a 30-year period, 30-year period, I can't imagine there's not going to be a black swan. So, and I like to be very conservative. So, yeah, I'm going to say at age, well, I'll tell you what, I'm going to let you come in and play with this yourself, but I will say that being more conservative, I would want to account for a black swan in here. It's going a little bit dark to say about what age and how much the portfolio is going to decrease, etc. And we've already counted for portfolio volatility. So I'm going to go with this for now. And I'm going to click Show Me, drum roll, to see what we come up with here after we've entered the data. Okay, so we ran 10,000 simulations based on your information. It's important to point out that this calculator, like most retirement calculators, uses a Monte Carlo simulation, and it tells you all the different possibilities from a lot of different possibilities. And the dark blue line that you see here indicates that this person would run out of money at age 74 based on the criteria that we entered. Now, for me personally, that I wouldn't, I want to count on living until at least 90, so that certainly wouldn't work for me. This light blue area, though, shows us the other ranges of possibilities based on what the returns are from stocks and bonds, as low as 70 and as high as running out of money at around age 81. And this is all based on stock market and or bond market returns, portfolio returns. And that's what I always really, really like to promote in my work and help people understand in my work, that the returns are what make the numbers work, what makes the math work. And the returns are going to be a function of the overall stock market, and that is a function of the economic environment. It's a function of things like interest rates. It's a function of Federal Reserve actions, and these are things that are outside of our control. So we have to be aware of this when we plan, and I think it really can be helpful to just look and say, where are we now and what do we see coming over the next few years? What makes sense? Are we overvalued? Are the assets that we own now overvalued, or are they undervalued? And use that as a little bit of a guide to see where we might be headed in the future. And remember, come over here, play with this, play with your numbers. The important thing to remember is that you can affect your own financial destiny by changing the factors that you see here. This is just the calculation, and it has a lot of input that you control. You don't control all of it, but you do control some of it. And remember, retire certain.